everybody. It is a cloudy Friday, but we still know what that means. That is right. It is episode 103 of the Real Deal Pod with Allister and Geoff. As always, it is I, Allister Carrington, alongside our trusted mortgage broker, our mortgage guru, Geoff Lee. Geoff, buddy, how are you on this beautiful Friday? Maybe not beautiful, but Friday.
Yeah, it's a Friday. It's raining outside, so that is never a good start to your Friday.
Right?
But yeah, it's another day it's another day in British Columbia.
In the golden ears. No, that's the golden ears.
I was going with the golden greens or something that identifies BC as colorful, but then I lost all my train of thought. I was like, oh, golden years. I was like, why?
That's awesome.
I look tanned in here.
You do look tan, buddy. It's amazing. It's amazing. It looks like you had a great time out in Mexico a few weeks ago.
Yeah, it must be my filters that I got onto this thing. I have no idea, but I'm like, wow.
Any plans for the weekend or?
You know what? I think it's just going to be a low-key weekend. Might do some dinner with some friends tomorrow. Chris's son is having his birthday today, so actually there's going to be a family gathering here for that.
Oh, happy birthday to him.
Yeah, Liam Joe, happy birthday.
Nice.
And then a buddy of mine is having a stag up in Whistler. So I don't know. There's options, but sometimes I may just want to do nothing.
Do nothing. Look at you. My wife and my daughter just got back from a little girls' trip that they took up to Whistler for a couple days.
Oh, nice.
They had a great time. They went to some light show. I swear I listened, but they went to a light show. I just can't remember what it was called, but Michelle told me all about it, and so did Elizabeth. And then I saw the pictures, and man, it looked amazing. So. Yeah, Whistler's looking good right now.
If it's the light show that I'm thinking, I think it's in the woods somewhere, right?
Yeah. They said it was absolutely spectacular.
Yeah, I've heard it's fantastic.
That's awesome. I got not much. I have to run out of here right after this pod, have a home inspection at my listing to open the doors for, so that the new buyers can make sure that the property is sound and stable, which it is. So excited to go do that today. And aside from that, same thing. I'm got a couple showings to go do, but I think it's going to be a quiet weekend, which I'm actually really happy for.
It's going to be good. Hey, I don't know if you know, but I'm working remote here, but your mic seems a little bit off. So I just want to make
it off or like quiet, or is it
quiet? It's better now. Yeah,
it's better now. All right, I just turned up the volume. I might have knocked it. All right, man. Well,
I just hate for you to do this whole pod and then nobody's be able to hear you. And I'm like,
nobody can hear me. All right, man. Well, let's kick it. Let's get started with the hottest segment in podcast, and that is... Did you know? That's right, baby. Did you know? So, Geoff, did you know that CREA expects a stronger finish to 2026 despite lowering its forecast? Yeah.
Do tell.
I will. It's actually fairly interesting. So CREA, which is the overseer of all real estate throughout Canada, right? So the Canadian Real Estate Association, and here in BC, it's BCREA, which is the British Columbia Real Estate Association. So the Canadian Real Estate Association has revised its 2026 forecast and now expects 336 homes, I beg your pardon, to sell across Canada this year. That's a 1.4% decrease compared to 2025. So we are now projected to be down 1.4%, which at the beginning of the year, as we can all remember, we were projected to be above 2025, right? And it's the second time this year the association has lowered its sales forecast. So already twice now we have lowered our forecast for sales this year. And at first glance, That might sound concerning, but here's the important part. The revised forecast isn't actually because the market is getting weaker. It's because the first half of the year was slower than expected. So buyers, of course, spent so much of the spring waiting on the sidelines. Concerns about inflation, higher fixed mortgage rates earlier in the year, and slower population growth in some regions all contributed to a delayed start to the housing market's recovery. However, the data suggests that the recovery may already be underway. So national home sales increased 0.9% compared to June of last year, and were also 0.5% higher in May, marking another gradual improvement. And I know, Geoff, we always go around and we laugh about the increases over the year before, considering the year before was so bad, and the year before that was so bad. But we've always said that the correction has to begin at some point. So we're always going to laugh at these numbers until we're sitting here talking about us being out of the correction. But the correction has to start. It does have to start somewhere. And so the fact that, again, that we've seen these increases happen, not just in British Columbia, but all throughout Canada over these past 2 months, are quite telling, even though they are quite small, right? So perhaps what was even more significant, the Bank of Canada again recently held its policy interest rate at 2.25% for the 6th consecutive meeting. So as you know, as we've talked about, Geoff, it's been the 6th month straight that we've now held our interest rate stable. And what they continue to say, and what Geoff has always continued to say, is stable interest rates create certainty. And certainty is often what buyers need before making a move. And what have we talked about, over the past little while? Geoff, you've been saying FOMO, fear of making a mistake. And I've been calling it FOMO, or fear of missing out. And I've been calling it FOMAM, fear of making a mistake. And I think that is maybe what these interest rates being held steady are starting to cement into the minds of first-time buyers, that it is okay. This is the time for you to make a move. CREA's senior economist Sean Cathcart believes that many buyers, especially first-time buyers, have been waiting for exactly this type of stability, right? If rates remain steady and home prices continue to level off, we could see much stronger activity after Labor Day as more buyers start to re-enter the market. Another encouraging sign is that the MLS Home Price Index, which measures the value of a typical home, remained unchanged from May to June. And that's the first time prices haven't declined month over month since January 2025. And that's another thing that we've talked about, Geoff, how prices have remained steady. That I think the biggest increase we saw, remember, was what, 0.3% back in May, and then they tailed off in June. They were down 0.1%, and I think they were up 0.1% again in July of this year. In June of this year they were down 0.1. So it's going to be interesting to see what comes about in July of this year. But again, we talked about if the price points aren't moving, right, aren't coming down by 5% and going up by 5%, these nominal ups and downs of 0.3% or down 0.1%, that more tells a tale of stabilization in pricing, right? So while the national average home price is still expected to increase by a modest 1.1% this year, CREA has slightly lowered that forecast to approximately $686,700 for an average price point of a home, which again reflects a market that's stabilizing, right, rather than accelerating. So what does this all really mean? To me, this report reinforces something that we've been discussing for the past several months. The market isn't booming, right? We know that. We've joked about that. But it's not declining either. So we are not in anymore what we were seeing in 2024 and in 2023. 2025 last year was rough, and we expected to pull out of the tailspin then, but we didn't, and we knew that a lot of that, right, was due to a lot of existential forces going on outside of our Canadian borders, plus some of the policies that our provincial government put in place that really, that really handcuffed the real estate industry in British Columbia. So now what we're seeing is a market that's not finding its footing anymore. I think it's found its footing, and it's now cementing their feet in that spot to start moving ahead. Inventory remains healthy in many regions. Affordability has improved compared to the past few years. And of course, again, as we've talked about, interest rates have stabilized. And these three factors create an environment where buyers can make thoughtful decisions without feeling pressured. So if CREA's forecast is correct, the second half of the year could look very different from the first, particularly in markets like ours in British Columbia and Ontario, where improved affordability is already beginning to attract buyers back into the market. So the takeaway is simple. Don't let headlines fool you. A lower annual forecast doesn't necessarily mean the market is weakening today. In this case, it reflects a slower than expected start to the year, while many of the indicators we're watching, sales activity, price stability, and interest rates, are beginning to move in a more positive direction. So that's your Did You Know for this week. That's your Did You Know? Now you do. Geoff, how do you feel about it?
Well, I like your comments where you have to kind of start somewhere, to start to correct in an upward motion. So yeah, I think it has to, everything always bottoms out at some point.
Right.
It's just a matter of when it's supposed to rise up. And again, me looking at things half full versus half empty. It's, we hear these reports all the time saying the same thing or similar things. And then, it continues to kind of correct. Right. So, CREA is a much higher power than my mind. They got the stats, they got all the details, they got all the the analytics behind it. So again, who am I to argue with that? But as I'm saying this, I remember I was in an event about I think 2 years ago, maybe 16 months ago, 20 months ago, where it's like, this is the year, this is what our stats tell us, this is what we're forecasting, a correction here in 2020, late 2025, mid 2026. And yet here we are, we're still flailing along. So time will tell, right? Time will tell. So I jokingly say, I always say this, the only thing economists agree on is nothing. And I always say that you can always find whatever you're looking for to feel good about what you're doing or feel bad about what you're doing. But I'm looking at things half full. It's a matter of like, yeah, to your point, you have to, at some point you do hit the bottom. And then from there, you make small increment steps to get back to the top, right? And I think that's what this report is kind of alluding to.
Yeah, and that's really what it is. They can see, and all, again, they can only work with the data that they've got right now.
Exactly.
Right. So they see activity moving forward, right? They see an uptick in activity. We've talked about it over the past couple of months. It hasn't been the condo sector, but we've seen investors moving into the townhome market. We've seen people that own single detached homes. We've seen them, right, leverage the equity into moving up, right, moving up in the category. So we've seen a lot of movements between those two categories over the past couple of months. Really, what we just continue to see is a condo market that continues to just to hold down the numbers, right? So it'd actually be really, really interesting if we extrapolated, that's a big word, if we extrapolated the condo numbers, if we took those out and we actually started just looking at what the market how the market's doing between the other two categories in detached homes and townhomes, that would actually give us a pretty good indicator of what our real estate, of the health of our real estate market looks like, right?
I like what you said too, as far as this is current data, right?
Yeah.
So this is data that's been accumulated over that period of time, which is actually a very good indicator as far as where things are at.
Yeah.
When people forecast, I have to remind myself and yourselves that we don't have the data, right?
No.
We're speculating
Right.
on the data that we have. So again, with the data that CREA has, if it's telling us that things are starting to stabilize and cementicize, I think you said, I'm going to use that word. I used that in Scrabble a couple of different times. But again, I think we continue doing what we're doing. And again, folks, like I've always said, is the best time to buy is when you can. If we talk about interest rates are at the second, I've said this a billion times now, it's at the second lowest that our country has seen. I think this is the second best market to buy in, from what I understand and from what I've been reading. There's really no reason why we shouldn't be now starting to taking those steps from the bottom and slowly getting to the next floor, as they say, until we get to the top, right?
Yeah.
So real estate is one of those roller coaster rides. But again, if you take a look at the history of it, it does have its ebbs and flows. But when the real estate goes down, it will always go up at some point in time. So
exactly.
the question is late 2026 that
When it's
time?
going to happen.
And
Yeah.
this is, I think, what this report is kind of alluding to, or these are small steps. But again, let's see what the new data says, or what the new information says as we get into July and August and September.
Yeah, it'll be interesting. It'll be interesting. And just a quick other, did you know, because Geoff, I found this quite interesting as well. Did you know, Geoff, that Remax Canada did a survey, and apparently 45% of prospective first time home buyers are going to be purchasing a cottage as their primary, as their primary residence. And they're going to start getting into the real estate market through the secondary properties, through the cottage market, the cottage industry.
It's interesting.
That's
where are the buying cottages? Like, I know in Ontario there's a lot of cottages. Here in BC, like, there's cottages, but where, like, I'm a little curious on that.
That's what so that was my question when I was reading it. I was like, okay, I still know that cottages in Ontario. So Ontario's lake is one of the massive lake provinces, right? So, but their cottages, I still think what the average price on them was 675 or 700,000. I know Manitoba, we have a lot. We have a lot of cottages, and right there, the average price of a cottage is 200,000, 225, right? So when you take out the big two markets, right, BC and Ontario, it sounds like a feasible thing, right? But once you put us in there, British Columbia and Ontario, that's where I like that report. I thought that's kind of crazy. How can those 45%? I don't see how they could be coming out of British Columbia or Ontario, because they'd have to know that it was more expensive to buy a cottage almost than it is to buy a single family home. Yeah. You know what I mean? So,
and not only that is I live in a cottage, and I know if I had to commute every day, I don't think I would live in a cottage, right? So cottages usually are in not remote areas, but semi-remote areas. Usually they're in destination places. So, and where is the work? Like how, I know how you're getting to and from, but sometimes in my little community, it takes an hour and a half just to get out of it. And it's only 10 kilometers to the main road,
Yeah.
right? Just
Yeah.
because it's so congested. So yeah, I'm a little interested in that
Yeah. It's
as far
interesting.
as what exactly that looks like.
Yeah. I'll do a little bit of looking. Hopefully I'll have something for us from it for next pod. But
All right.
awesome, buddy.
Well,
So let's get into your side.
what I want to talk about a little bit is about how people can future proof their mortgages. And what I mean by that is that many of us will get into a mortgage today, but what is our lives going to look 5 to 10 years from today? And if you kind of get an understanding on how you can, future proof your mortgage and have a discussion in that and what that's going to look like, it's one of those things, Alistair, is like you may not remember everything on how to future proof the mortgage, but if you can remember just one thing, it may lead into other questions that might trigger when you are in that home buying process, right? So one of the things that we've always said, or what I always hear on the daily, and I'll just pose this question to you, Alistair. What is the one thing do you feel that most people are asking you or asking me when they're purchasing a home?
How much down do I need?
Okay, next, that close but no cigar.
What's the rate?
What's the rate, right? Let's say one of the first three things people are asking.
Actually, I should have said that. That is the first thing that I'm asked. But
Right, is
I thought we were kind of completing, like we were already chosen the house and we were completing, so I didn't even think about it there. That's why I
yeah.
went down payment.
Well, down payment, I'm sure like people ask as well. But the one
Yeah.
thing that I hear even before anything else
What's
is,
the rate?
well, what's the rate? It's not even like, well, do you even qualify? It's the first question we get
Yeah.
is what is the rate?
Yeah.
So, it's like this is what we focus on. What is the rate? What is the rate? What is the rate? But how to really future proof your mortgage is also asking different parts of what that mortgage might look like, as far as what is the prepayment privileges, right? What are the portability options? How are the penalties calculated? And I've said this before, just asking what is the rate is like going on a date just purely on great looks, and then you kind of get deeper into that relationship and you get married, and then you discover the personality of that rate isn't quite the way that it presented itself. Just like a lot of us who have went on first dates with people that are gorgeous or the lady's handsome, and then basically you get 3 hours into that conversation or even 15 minutes sometimes, and you're just like, there's not much more in this particular individual outside of their looks. And a mortgage can be a lot like that too. Is like, if you're only looking for one thing, you might be missing out on the personality of it. And the personality of it might be really, really ugly.
Yeah.
Right. And again, it's about what are those prepayment privileges? What happens if I sell the place that I'm in and move to another place and I need more money, right? Or what happens if I downsize and I need less money? And that's what we call the portability options, right?
Right.
That's what we call the blend and extend options, or blend and decrease options.
Right.
How is the penalty calculated? Because understanding, Alistair, I'll give you a quiz, and I've asked you this before. What is the percentage of people breaking their mortgages here in Canada within the first 3 years?
What is it? 80%?
60%. So
Okay.
6 out of 10
6 out of
homeowners
10. Right.
will break their mortgage, they say, within the first 3 years.
That's
And
still crazy to me. That's still a stat that's so crazy to me. Yeah.
yeah, and again, like why do people do that? Like I'm not one of them.
Yeah.
I've lived in my house for 23 years before I moved, right? So when I hear that stat, it's just like, there's no way, right? There's no way that is. But again, these are based on actual statistics,
Yeah.
right? They're tough to argue when you can have the history to back it up. But why do people sell their or not sell their house? But why do people break their homes or not break their mortgages within the first 3 years? They may be upsizing,
Yeah.
right? Their families may be growing.
Yeah.
They may be downsizing. Maybe their kids have left and now they're becoming empty nesters.
Yeah.
People that are in that 25 to that 35 year mark, even late 30s, maybe they're changing careers,
Yeah.
right? Maybe they're relocating. Maybe we're going through a life event, a medical event, a divorce, a separation.
Yeah.
But there's so many reasons why people will break their mortgage really within the first 3 years, and those are some of them, right?
Yeah.
One of the personalities that people should be asking about, outside of what is the best rate, is basically, well, what are my portability or what are my prepayment options?
That's
Right?
always my biggest. I think the biggest question for me.
Yeah.
Yeah.
Again, we have the biggest debt of our lives, probably the best debt of our lives, and for a couple of different reasons. This is a debt that appreciates over time. Typically, it's your lowest interest debt, right, that you have. But a lot of people, their primary goal, especially in an older generation, maybe not in our new generation, is to pay off their homes as quickly as they can. And I used to always say, it's the last thing you need to pay off, right? Because it's the lowest interest debt that you have, and reinvest that money. But I'll be honest, not that my views on that have changed. I'm still a big believer that this is the last debt that you should pay. You should pay off your highest interest debt first. And once that is done, then you reinvest your money, and you leave your mortgage as it is. But again, like people, the older we get, Alistair, we start to see things that you don't see when you're younger,
Yes.
right?
Yeah. Yeah.
You start seeing people struggling with their finances because they've made maybe bad investments, or their business is going sideways, or their business, let's talk about developers, were just doing fantastic, and then all of a sudden the bottom fell out and they're losing their shirts, consumer proposals, bankruptcies, and all of a sudden it's just like, I just over leveraged myself. And you have that older generation that says, well, you know what, at least I have my house paid off,
Yeah.
right?
Yeah.
um, and I've always said to people is like, hey, everybody has a different debt strategy. But there is nothing wrong about paying off your house, as your first goal to get rid of, or your first debt to get rid of.
Yeah.
It's a little bit of an older strategy versus what the new strategy is. But again, I've just seen a lot of people as I get older is just like, you know what? Man, that nice conservative strategy isn't necessarily a bad one, right?
Yeah.
It's not as sexy as the other stuff because your returns and aren't made what they need to be. But again, it really hedges against turbulent times. Is if you have a home that's free and clear,
Yeah.
right, or almost free and clear. So
Yeah.
having a prepayment and understanding what your prepayment privileges are very, very important. And all banks are not the same. Again, we can have a great rate, and you may not even have a prepayment privilege because it has that personality, right? And the reality of it is that people want the ability to make lump sum payments. The reality of it is, lenders have prepayment privileges of up to 20%. Making that lump sum payment on your loan amount can happen on the anniversary day or the birthday of your mortgage, or it can happen throughout the calendar year. Every lender is not the same. Some lenders will allow you to increase your monthly payment up to 20%, in addition, doubling it up, right? But also keep in mind, folks, is that if your goal or one of your goals is to pay off your mortgage as quickly as you can, you don't necessarily need the max, because statistics also show that most people don't actually utilize their prepayment privileges,
Yeah.
right? And the ones that do, the maximum that they do is typically 10%, right? Again, and everybody knows themselves better. I just worked with a client yesterday. This guy had 3 places. He had no mortgages because that was his goal. So prepayment privileges were really, really important to him, right? So he fell out of that statistic, whereas he was the person that would do lump sum payments of 20% of the loan amount. He would be that individual that's increasing his monthly payment by 20% and doubling it up, because that was his debt strategy, right? So that prepayment privilege was really, really important. But again, Allister, guess what his first question was to me?
What's my rate?
What's my rate, right? So getting deeper into the conversation with him and understanding, what's important to him, and also just taking a look at his application, and it's pretty black and white as far as if you got 3 homes and no mortgages on it, and you got great investments and savings. It's pretty clear as far as what his strategy is, right? But again, if you're just asking that one question,
what's my rate?
And you're not asking about the personality of it, you know what? You might not be getting the opportunity to capitalize on that personality, right? So again, folks, if you're still lingering in that thought, is like, I can't believe 60% of us will break our mortgage within the first 3 years. Why do people do that? And again, you move, you upsize or you downsize, right? Back in the COVID days, when houses were just increasing equity in hundreds of thousands of dollars, sometimes you're refinancing to tap into that equity for reinvestment purposes, or maybe you're consolidating consumer debts. The reality of it is, I think it's 6 out of 10 as well of us will get separated or divorced. And that life event hits you, and that's why you break that mortgage, right? Job relocation is a huge one. Just working on a file now. They're in BC. They're now moving to Alberta. They don't have a porting option. The mortgage that they were in, we didn't do it, but that mortgage that they were in doesn't allow them to port. So now they have to break that mortgage. So it goes back to, again, the personality of the mortgage. Well, what if I do have to break it? What is the calculation into breaking it? Because again, as we've talked about over past pods, is if you're with a big 6 bank and a fixed rate mortgage, they're calculating it at a much different way than if you're with a credit union or a monoline lender, and not in your favor, right? So again, that personality can save you thousands of dollars if you're asking the right questions.
It was my second question is, how much is the penalty if I have to break it? That's actually usually my second question.
Yeah, and that's a great question. And now, if you're in a variable rate mortgage, and regardless if you're with a big 6 bank or a credit union or a monoline lender, which again is a lender that only strictly deals with mortgages and only available to mortgage brokers, if you're in a variable rate mortgage, it's always a 3-month interest penalty, right? So regardless of where you're at. But again, some of those lenders, Allister, won't allow you to port that variable rate mortgage where other ones will.
Right.
Then with fixed rates, how those are calculated, like with the big 6 banks, the big 6 banks will take not the contract rate that you're in, and say that contract rate is 3.5% or whatever it is. They'll take the Bank of Canada posted rate, which is much higher, and then they'll calculate the penalty on that, right? Credit unions and monoline lenders will actually take your contract rate, the rate that you're currently paying your mortgage on, and calculate the penalty on that. So the difference between the two can be thousands of dollars, right? But again, that's part of the personality of the mortgage, is how do I break, or if I was to break my mortgage, how is it calculated? If I am in a variable rate mortgage, can I port it, right? So again, all the personalities outside of, well, what is my rate? The other part of it is if you're in a variable rate mortgage and now you're upsizing and you need to borrow more money, can I port that variable rate mortgage and basically get more money? Again, some lenders will allow you to do that. Some lenders won't. Again, it's the personalities of the mortgage. No 2 people are built the same, unless you're fraternal twins. Is it fraternal twins?
Yes.
Yeah, unless you're fraternal twins. Throw that in there. So again, keep in mind, folks, like, what is your lives going to look like 5 to 10 years from the day that you purchase your home? These are the types of things that you need to be asking yourself, or your lending partner is supposed to be asking you to give you a better understanding as far as the right type of mortgage that you need to go into, right? And again, this could come down into debt consolidations. As far this can come down into accessing equity, and I'm talking about refinancing here, accessing equity to either do future investing, possibly home renovations. And again, it could be also accessing equity as far as helping family out. There's a statistic that came out, I think it was through CMHC. This was probably maybe within the last year and a half, 2 years that they may have done it. But the average gifted down payment from family, Allister,
Yeah.
and again, how much do you think that is? The average gifted down payment from family for you to purchase a home.
I think I heard this. I think I heard this. So I'm gonna take a stab. It was like 300. Was it 300,000?
$300,000. So again, how are and people are gonna, I can tell you right now, is like, I want that to be my parents. But the way that the way that is happening is because people are refinancing their homes. They're tapping into the equity. They're using that equity to help their family out, right? Or they're refinancing, tapping into that equity to reinvest or to home renovate or to consolidate their debts.
Yeah.
So again, understanding on how that penalty is to be broken, or how that penalty is to be calculated, broken to access that future equity, very, very, very important.
Yeah.
Right.
I just
where I'm going.
Sorry, I was just going to say, I just took took clients out on the weekend, and one of the homes that we went to, I was talking with the owner that was selling, and that's what he's doing. They were actually selling so that the two kids that they could have, one's married and the other one has a long-term girlfriend, that they can all move on into one property together. So they were selling and breaking in order to upsize.
Yeah. And I just worked on a file. These folks had $53,000 of consumer debt. They had equity within their home. When we did that debt restructure, they were saving themselves $3,000 a month of liquid cash as far as what they would be spending if they didn't do the restructure. And it's not like we recreated anything. We just restructured their debts, and we had the ability to do it because they had the equity built within their home.
Yeah.
Right. So again, that's $36,000 a year. And over a course of 5 years, we just saved them almost $180,000, providing they don't jump back into their debts.
Right.
Right. So again, these are some of the reasons why people will do that. Like in your particular situation, they're selling to come together as a whole, right? As a family, like a generational family unit, right? In this particular case, they were refinancing, accessing the equity to do a debt consolidation. And again, if they kept things nice and clean and tight, that's $180,000 of savings.
Crazy.
Right? Yeah. So again, these are some of the reasons why people will break their mortgages within the first 3 years that they have them.
Yeah.
So when doing a mortgage, folks, have a long-term strategy. Know what your goals are. Have an understanding what your income is going to be. And typically it's going to be more than what you're making when you first, start your home journey. What are your future plans, right? And what is your lifestyle? And at the end of the day, understand that just asking that one question, what is the rate? And you're not asking about all the other personalities of the person that you're going to, or of the debt that you're just going to get into a long-term mortgage marriage in. If you don't know what the prepayment privileges are, if you don't know if you're allowed to port it, if you don't know if you're allowed to borrow more money or use less money, if you're downsizing or upsizing, if you don't know how the penalties are calculated, you may be getting yourself into a mortgage marriage that is going to cost you a lot of money because you didn't ask the right questions. Just like many of us, not me, but many of us will just marry someone purely on their good looks and then realize how batshit crazy they can be. And then you end up in a divorce, 6 out of 10, just like, hey, it's just like how many people break their mortgage. 6 out of 10 of us, you want to make sure that you're not going to be losing your shirts by making a bad decision just based on good looks and a low rate.
Yeah. Yeah. That's awesome, man. I agree. Like I think that's one of the things that we don't do enough of anymore, and that's asking questions before we jump into a contract, right? A lot of people like when what's the rate, or they get a cell phone and they're like, what's my cell phone payment going to be? And they don't read the contract or anything that they're entering into or anything like that. And it reminds me of when I was young working at Future Shop as a sales guy and selling computers. People coming in and saying, oh, I saw this computer in the flyer and I want to buy that one. And then you start asking them questions about what they want to use it for, and you find out that what they need is something a lot more than what they're going to buy. And then you have to explain to them and say, hey, why are you going to buy this for $800? And then you're going to have to come see me in 3 months to buy a whole new computer for $1,200 to fit what you need now, right? So you're spending $2,000 instead of the $1,200 that you just need to spend to get what you need, right? And I think that that's what we need to start doing again, is start asking the questions, not just the superficial ones, what's my rate or what's the cheapest thing I can get, but actually start looking at our purchases based on what we're going to need, right? Yeah. Something, and as you said, future proofing, right? Future proofing your mortgage. It's just future proofing your life so that you're not spending essentially double the money that you have to by buying things because it suits you right now, and then 2 months later having to buy something that fits you later on because you grew up a little bit more, right? So it's so important to ask the question so that we're always purchasing something that we can grow into. And homes are the exact same thing. Instead of buying a 1-bedroom because there's only one of you right now, think about buying a 2-bedroom if it's still affordable, because you may get married, then you may have a child, and you're going to need a place to put that child. Right? As opposed to
and even if you sell it, if you sell it as the market corrects, it's gonna be worth a lot more than that.
It's worth more. Exactly. It's worth more. So again, by asking questions and purchasing things that you'll grow into as opposed to growing out of, it sets you up way better in the end. And that's really the type of advice that you should be relying on from people. Not people that are willing to satisfy your right now and that's it, but who are the people that are here to help you right now and satisfy your needs in the future, right? Those are things that I think that we really got to start putting back into our thought process and our practices as we go.
Amen.
As we go through. Yeah, man. All right. Well, is that all we got today? Is that it? Are we wrapping?
You got a home inspection you need to be in 15 minutes, so you got to bounce.
I got to get out to Richmond. Hopefully, there's no accidents in the tunnels. So everybody, thank you so much for listening to us today. Have an amazing weekend. I think it's supposed to rain, but if there's any breaking sun, get out there and enjoy it. Have an amazing week. We will be back here next Thursday or next Friday. Whew. But in the meantime, stay empowered, stay informed, and Geoff,
stay tuned.
That's right, baby. Stay tuned. Peace out.